Welcome to Stocks in Translation, our essential conversation cutting through the market mayhem, the noisy numbers, and hyperbole to give you the information you need for your portfolio. Today, I am excited to be joined by Sylvia Jablonski. She is a Defiance ETF Chief Executive Officer and the Chief Investment Officer.
Hello.
Thank you. And also Sydnee, our intrepid producer, who is going to be chiming in with some very prescient and revealing questions, I hope.
Always,
Yes.
always I do.
And our theme for today, if you can have a theme that's based on a theme, it is thematic investing in the roaring 2020s, because that's what we're in right now. Perfect topic for a CEO, that would be Sylvia, who heads a thematic investing ETF business. This is not a coincidence. All right, and our word of the day is FOMO. Is it really one of the all-time greatest risks in investing? Keep an open mind. And this episode is brought to you by the number $7,284,319 million. That is the size of the Federal Reserve's balance sheet. Why this matters to you. And Sylvia, Sydnee, first let's talk about our theme of the week, thematic investing in the roaring 2020s. Just want to get your overview on the market. Major averages, the Dow, the NASDAQ, near record highs, but we've seen a lot of defensive things kind of creep into the market recently. How are you seeing things?
Yeah, I mean, it has been a very interesting market this year. And in 2022, I was sort of looking forward to this.
I think everybody was
looking
in that bear
forward
market.
to what would happen in 23 and 24. And I look back at that market and you thought about like just how, sour everyone was on everything, particularly tech. And look how that turned out, right? And we'll talk about FOMO later,
7.
right?
Yeah.
But yeah, Mag 7. But, I think that overall the market is strong. There are certainly some risks in the market. We have the highest levels of debt that we've ever had. But if we just take a step back into the near term, people have jobs. They've had wages increasing. This stuff is slowing down, but they still have, strong pricing, purchasing power. The consumer's in good shape. Corporate earnings have just been great. We're expecting 14% growth in earnings next year. That tells me that that's a very good thing, coupled with potentially a Fed that's going to cut. So in the near term, I do see, some volatility around news bits, whether it's geopolitical issues, a change, shift in inflation. But overall, inflation is coming down. Corporate earnings are strong. Corporate America has held up. We're still spending some money. I think that the market's in a pretty good spot.
All right, I'm a bull. Let's talk about some of these themes here. AI, the biggest one.
Yeah.
It's been expressed through Nvidia, the poster child, and we can talk about Nvidia, but it's broadened out because now we're talking about power, electricity, kind of the nuts and bolts to make AI happen. What is your thinking of managing an ETF or managing a suite of ETFs that's kind of in this business?
Yeah, so I'm so excited about this. So first of all, I'm an Nvidia holder. I love that stock. It's the best thing since sliced bread this year.
Because it's up so much.
Because it's up so much, right? We love it.
Right.
But so interestingly enough, we started our company in 2018 around the idea of, there's $7 trillion of wealth that's going to trickle down from baby boomers to younger people, right? And younger people, kind of being anyone who's like tech savvy and believes in something beyond the old classic traditional computers and stuff like that. So we thought AI is going to be the next big thing for sure. And we were a little bit early, and that ChatGPT moment is really what kind of, spiced up our ETFs and our asset flow and things like that. But we thought when we constructed the ETFs, it was like, let's think of a theme that captures all of AI. So there's AI, semiconductors, there's, quantum computing, supercomputing, there's data, there's teleconnectivity and things like that. So we had a 5G ETF, which is the AI, tech connectivity. And then we had quantum, which is supercomputing, semiconductors, companies like IonQ that are, going to process data in multidimensional ways that
I'm not familiar with the company, but it sounds intimidating.
Yeah, it sounds intimidating, but I guess that's kind of the point of thematic investing, right? So you want your Nvidias, you want your Microsofts, like the companies with the strong balance sheets that hold up the portfolio. But once Nvidia has run up and you're not in it, and this trend is still going and growing, it's going to start filtering into these other areas. And having an ETF that gives you exposure to the small caps, mid caps, large caps, you get the balance of the safety from the large caps, but then you get those maybe 10 baggers if some of these small caps.
The small ones that become large caps.
Yeah, exactly. So it's a well-diversified way to play the AI theme. I think ETFs really matter in these types of sectors.
So Sylvia, let me ask you a question because you mentioned a little bit the great wealth transfer. So I'm going to ask you about the early investor. Should a first-time or early investor, someone in their 20s maybe, is the way in through to AI through ETFs, or should someone just own Nvidia? Should people own the stock straight out, or is it just a little bit easier to go in through the ETFs?
I think if you're 20, unless you're super wealthy and you can drop, where is it at? Like $1,200 or something like that today. It's expensive today to buy. So I think ETFs tend to be priced a little bit lower, the management fees lower. And then again, like you get this broad diversified portfolio. So for example, we've got an ETF, our quantum ETF, it has Nvidia, AMD in it, but also has Microsoft, Apple, Hewlett Packard, so I think that if you're going to hold something forever, it's not a bad idea to have a diversified ETF. But the answer is, I don't want to just like toot my own horn, because I think it's perfectly fine to buy a stock that you really believe in. That stock is about to have a split. So, go on in, get on in.
Maybe I have to wait for that, because I'm not shelling out $1,000 a share.
Wait for that. You're probably more likely to, buy a couple shares at $100 than you are at, where it's at now. So
what about some of these other themes? Maybe not so AI intensive, but still important on people's radar and disrupting an industry.
Yeah. So I think again, like if I think about AI, like and I like bleed it down. I mean, you can think about the commodities, right?
Sure. Copper, we saw that at recent highs.
Yeah, exactly. Copper, uranium. These things are in high demand. There's low supply. There's geopolitical issues impacting this. In the case of uranium, we want to be carbon neutral by 2050. How is that going to happen? Nuclear power is the cleanest, right? We're having a lot of global government investment in that space. So you look at products centered around uranium or the commodity itself, copper, just basically like hydrogen, EV, like some of these alternative power sources I think are super interesting. And the biggest theme, it's really playing out now, like the roaring 2020s, the biggest growth and new product launches that we've seen come out and filings that are with the SEC now are for income generating products. So all of these covered called ETFs, zero DTE put ETF products, you have exposure to an index and then you generate income through options.
Do you think it helps that interest rates are up generally?
It does, because what happens with that money is when you're selling in the money option, or slightly in the money puts, or you're using covered call strategies, that money sits in treasuries, and like at baseline you're getting 5% before you employ your strategy. So it helps, but there's so much income that is coming from, selling these short-term options that settle to cash, that even if rates fall, even if, inflation shrinks and the Fed cuts, it's de minimis in terms of the actual return of income for these funds. These options generate so much premium.
I got a twofold question here. Back to the early investor in terms of commodities. Again, are we going to go ETFs, or how are we getting in there?
So I personally go into ETFs for commodities, and I am a stock picker. So again, I'm not showing my biases towards being an ETF person, just because I think that several commodities right now have supply demand constraints and are poised to grow, and it's kind of cheaper, functions well in an ETF product. I'm not trading futures day to day, and it's easier in the ETF wrapper.
Yeah. Go ahead.
And then I just had one more. Why are we talking about leveraged ETFs? Why are those more risky for investors?
Yes, and you have at least one in uranium?
We have one, And so my background was in levered inverse ETFs. So I used to just spend my time talking to like really technical model-based traders that are looking for short-term. So levered inverse ETFs are just that. They're short-term trading opportunities. Why they're risky is, if you have an upward market, it's compounding on top of compounding, great returns over time. If you run the performance of some of the 3 times levered tech ETFs, I mean, they're up over 15,000% in the last decade or so. But the risk of that is range-bound volatility, right? So every day you're buying high, you're kind of selling low over time. Trend is your friend. If you don't have a trend, you tend to do worse than the underlying. That's the big risk.
I saw this early on when I was looking at leveraged ETFs, and it's startling how if you have a market that's going net up over time, but in a very volatile way, you can actually lose money.
You have to, trend is your friend. You have to be, short, directionally short to win on the short funds, and directionally long to win on the long funds. Anything in the middle can be tricky. And then a lot of people have figured out that because of that, another trade you can do is to short both the long and the short.
Oh, interesting.
So you win
arbitrage game there
with the range-bound volatility, because they're always catching up. And
read the prospectus, as they say. All right, but time now for our word of the day, which is FOMO. And if you thought it means fear of missing out, you're right. But more interestingly, We want to explore how this dynamic, and it encapsulates both greed and envy as it works its way through the minds of investors and into prices. What does FOMO mean to you?
I mean, FOMO. So I think that it's interesting because I've been thinking a lot about this word when I've been talking to recent graduates and interns and things like that. I absolutely think you should have FOMO of not investing. You should, I think that investors should dollar cost average forever, build their portfolios. You should have that fear of missing out. Like your cash should not sit in a bank account. Like, so on a basic level for me, that's
FOMO's good.
FOMO's good, right?
Okay.
But FOMO when a stock is at its all-time high and you're buying it that day at that print, like...
Are you looking at those 1,000% returns in a week?
Yeah, market timing doesn't work. I mean, I thought I could do it in my early 20s. I couldn't. And like, just staying invested, kind of having that discipline and, staying in the market, buying along the way, picking up your acorns. That in my mind always seems to work for the average person, and so that's how I think about it. So I don't have FOMO if I'm not in a stock today that goes up 20%. If it falls, 20%. If it falls in a couple weeks, I'm going to get in, right? So,
but Sylvia, so if someone did miss the boat,
yeah,
I mean, we can even use Nvidia. Let's say there's no stock split; it's at 1,000. Everyone's talking about it. Like, they didn't get in at the right time. What's the cure there? How do they kind of solve that? How do they think about what they should do next?
There's no cure. You've never missed the
no.
boat. No, you've never missed the boat. You've never missed the boat. There's always something to invest in. You know?
Well, that's just a perspective.
That's a perspective. I think you can always invest. You can always stay invested in like the Nasdaq and the S&P 500 over time. If you want to get into a specific stock like that, wait till it pulls back, or consider the ETFs that have the highest positions of that stock in it, but are priced at lower levels and have Intel's, AMD's, other types of Taiwan Semiconductor, other types of companies that might also rally around that stock rallying. So you never really are at a loss if you didn't catch the high.
I got to pause right here. We're taking a short break, but coming up, we're taking a tape measure to the Fed's gargantuan balance sheet. And we've been talking about FOMO. And Sid, I could tell you had a burning question just before the break.
Yeah. I just wanted to ask one more thing because I'm obsessed with the early investor or the average investor. Let's use me, for example. If you had to tell me one thing in terms of investing, and you're talking to graduates, you're talking to a lot of these people, what would you tell me? One piece of advice.
Yeah, I'm not going to like it, but if you're young, don't go out every night and spend all your money on food and drinks and stuff.
No, you're telling me
you
not
want
to
build.
live.
No, I want you to live, but but live in a way where maybe there's one day a week that you can cut back and put that money to work for you, so that you have financial freedom and financial independence when you're a little bit older. You don't have to give it all up, but it's so interesting. I have 2 kids, and I have young women that are babysitters, and they're talking about I have to take this credit card debt because I have to go to this wedding.
That sounds very responsible for a young person.
And yeah, but I have to buy this wedding dress. I have to fly across the country and do this, and this wedding is going to cost me $5,000. And I haven't talked to this person in 5 years. Don't go to the wedding. Take the $5,000, put it in whatever you want. S&P, crypto.
I mean, this is our word of the day. Yeah. FOMO, though, and that's a lot of young people in terms of picking their vacation, their wedding. They feel like they have to go to these things. It's another version of FOMO, and investing in your future, not going to these things maybe all the time.
Totally, but it's not your best friend. You haven't talked to that person in years. That $5,000, if it compounds, you know what I mean, over the next 20 years at 10%.
You got some real FOMO if you're doing the math.
Yeah, do the math. That's good. Do the math. That's the FOMO.
That's fair.
Yeah.
I like how we're kind of talking about risk management. That's something that we like to talk about a lot here, and we've done entire shows on it. What does risk management mean to you? And you were talking about your personal trading history. You're not a market timer, but for a passive investor, somebody who plays these markets, what does risk management look like?
Yeah, so risk management is having, I think, exposure to. So if you're a novice, if you're not, kind of studying corporate earnings and dissecting every stock and this and that. I mean, I definitely make decisions based on the fact that I've been obsessed with the market every day for decades too, but I would say that, if you're kind of new to the markets and just want to invest, it's perfectly fine to find a super cheap S&P 500 ETF, NASDAQ ETF, put some money in there. You automatically have diversified exposure within those types of products. And if you're young, I mean, you don't need the fixed income hedge. You don't need the short VIX or anything like that. You're going to ride things out over time. But I think for most investors, it's broad-based index exposure, throw in some stocks that pay dividends, some commodities and alternative income that perform the opposite way of the market. So if you get a crash, it gets buffered over time. So diversification.
So Sylvia, when you're picking an ETF or any asset, really, people always say, like, do your homework, right?
Yeah.
But there's all
read
these.
the
You said read the perspective. Read the prospectus. These are long documents.
Which no one does. Yeah.
That no one does. And
professional investors do, but yeah.
Exactly.
Yeah.
Like, what are you going to do? Sit there forever, Google every word you don't understand, which
or
might
rely
be a
on
lot.
an expert.
Yeah.
Rely on an expert. So
Right.
why is this so complicated, and how can we kind of fix that?
Yeah, so I think it's actually become less complicated, right? Because there's so much just media, social media, explanations, podcasts like we're doing that talk about these different products and like what to be thinking about. And so I think, on a basic level, like just keep it simple. Like look at, the name of the ETF and look at the stocks inside of it. And does it seem to fit with what they're saying? Look at the performance that they've provided and know that that's not a guarantee, but you get a sense. And then look at the fee. Nothing has to be that expensive these days in an ETF wrapper. That's why mutual funds kind of started losing all of their assets, right? People realize that you don't have to pay 2% for, something that costs 2 basis points in an ETF wrapper. So, but the other thing is call the ETF company, ask them questions.
Interesting.
Put them on the
Very
spot.
interesting.
Call Sylvia. We're
Call
going to put
me.
your number on the screen.
I get, you know what? We probably get about 40 inquiries a day, and I answer every single one of them. I don't do it in the same day all of the time, but like on the weekend, I'm
Our
logging
viewers
in,
might put you to the test.
trying to get back to everybody. And we should.
But I
we should.
appreciate that because almost famously, to the detriment of retail traders, a lot of management companies don't want the phone calls. So,
Yeah,
so kudos to you.
It's a great question actually, because I'll tell you what, we have products where we have 2 products that are similar and do different things, and people are in kind of the wrong product for what their goal is. And I often tell them, no, you should actually look at this one. And then there are people in that one where I'm like, no, actually, like your risk tolerance is more in line. So I think people can help you, and most ETF companies have loads of employees that are willing to pick up the phone every day.
All right. This episode, if I didn't say it before, is brought to us by the number 7,284,319,000,000, and that is the size of the Fed's balance sheet. While that is a huge number, it's down from 9 trillion in 2021 in the wake of the pandemic stimulus. So are you leaning towards mission accomplished, or we got a lot of work to do here?
I think we have a lot of work to do.
Yeah.
I mean, the size of it is astounding, and it's kind of that thing that lingers in the back of my mind. Like this does have to get in control, depending on kind of like what happens in the next election, what the spending is going to look like. Like I think this has to be very much a focus now. Like we shouldn't just run at this level and just think it's okay because it's down from 9 trillion. It's way too high. We have to do something, right?
It never got that low the last time.
Yeah.
We drew. This is the second time we've had QT, and they just didn't get down that much before we had this incredible pandemic.
Yeah.
All right. I do want to get to our final segment, and we'll get into some personal stuff here if we have time.
Okay.
But this is Who Wore It Better? This is a modern financial take on a Hollywood staple. And today we're going to be keeping the AI hype conversation going. We're going to ask you to compare Nvidia, the undisputed poster child of AI, to Amazon 2.5 decades ago at the height of the dot-com bubble, so 1999. Yeah. A young Jeff Bezos had captured magazine covers and imaginations by selling books. Remember, it was just books back then, but Amazon was such a hit that the stock was up 7,000% in its first year and a half. Bezos split the stock 3 times before the prior millennium wrapped, and I think we all know the Nvidia story, so I'll just ask you, is it Nvidia or Amazon that is riding the hype train better?
Oh man, I mean, I think it's actually a really hard question. One guy flies to space. We were talking about this off camera. The other one is now signing autographs on T-shirts and things like that. And he's the man, kind of the man of the market of the year. In terms of the companies, I think, in terms of like, if I think about what Amazon started as, it was a bookstore, right? Mm-hmm. And now look, right? Now it's like a healthcare company. They do AI, they do quantum computing, they do e-commerce, they do videos, they do all of these things. And so I think just diversification off of a really basic idea is better. But
The true AI leader might be selling pencils now.
Yeah.
I mean,
right.
Metaphorically, it's kind of taking that to an extreme.
100%.
Right, but I'm not. I think it's a close race, and now I mean, the whole world wants to be invested in Nvidia. The whole world knows who Jensen Huang is. I don't think anyone knew who he was a couple of years ago, even though Nvidia did so well.
Even a year ago, maybe.
Everyone knows who Jeff Bezos is. I don't know. We'll have to see who remains a little.
Is this just a matter of time, though? Like, back then when it was up when Amazon was up 7,000%, you would say Amazon, really? Like today, maybe you'll just say Nvidia because it's the thing of the time.
Look, I think it's the thing of. I think it's so for the next 5 to 10 years, without a doubt, Nvidia wins. I just think that we're not even getting started with AI. We haven't heard yet how it's impacting healthcare, aerospace and defense, military, just every single sector out there. Even Salesforce, like their earnings were horrible. And if you just think about they're not horrible, but they just weren't good, right? If you think about them actually implementing AI, I've used that system. It's so clunky. If you get AI to work, like that stock's going to take off, and then Nvidia takes off, right? So I think it's the next 5 to 10 years belong to Nvidia.
I'll tell you what, Sid, I was just looking at the technicals on Amazon. Yep. It has formed this multi-year cup and almost a handle here. So basically,
back to the cup and handle.
It hasn't quite really broken through its prior highs, but it looks like it wants to.
Yeah.
I would say this is something that Alphabet recently did, and it's flying higher. I think maybe it was Nvidia was the first to really put in the similar chart formation. But it's funny how a lot of these Mag 7 stocks have the same charts, but they're just evolving on different time frames and kind of hitting at different times. We got a few minutes here, so maybe you can tell us about how you ended up starting your own shop here. You were in the ETF business for a while, but I think you started in banking way back in the day.
I started in banking, yeah. So I did, I did the finance economics thing in college and grad school, and so I always had an interest in this. And I started out on an equity derivatives trading desk, and so I used to do all of the kind of swap options, synthetic forward trading for hedge funds and big ETF companies and things like that. And at some point, my former employer, Direction, had, they were coming out with the 3X long and short financial ETF. It was the heat of the financial crisis, and they wanted somebody who knew about swaps, and it was kind of startup
Nobody
vibes.
raised their hand?
Yeah, well, I mean, swaps and wanted to try something new. Because at that point, I had been rebalancing all the trades. So I really knew their business.
We're talking about lots and lots of money.
Yeah, lots and lots of money. And at that point, they were a little less than $1 billion. I stuck around for 10 years and left when they were about 30 billion. But while I worked there, I was at some point managing capital market sales research, and there was a guy who worked for me on the sales team. He was a senior sales guy. We used to run around the country together trying to do education on levered ETFs and all this stuff. And we'd always talk about how could we have to be able to do this, right? There's still room for something else out there. And we would talk about how we'd go to Boca, and all of our grandparents would be giving their kids money, and they didn't care about the classic stock sector ETFs. They wanted, they wanted to invest in spaceships and things like that. So we always, thought about it. So it's actually my colleague who founded the original company, and then myself and 2 other people joined him, and we're now Defiance ETFs. And cool story about our name. His grandpa and uncle are who the movie Defiance is based on.
Oh, very cool.
Yeah, so
I'm going to have to look that up now.
Yeah, you have to look it up. Yeah, so his last name is Belsky, and they're the bipartisan heroes. But so we kind of went into this, and here we are. We're at about 1.5 billion in assets now. We've learned a lot, made a lot of mistakes, gotten a couple things right. Hopefully get a little more right. And
good for you.
It's awesome. I have a passion for it. Yeah, I have a passion for it. I genuinely love markets, fund construction, ETFs. I'm so into this.
All right. Well, we got to wind things down now. Thank you again for gracing us with your presence and knowledge here today, Sylvia. May your powder be dry and your account balance be high. We're signing off here at Stocks in Translation.